Good morning, people. So, new day. So, we're starting with a new topic, financial instruments. This particular topic has significant weightage in exam. It is considered probably one of the biggest topics in your FR syllabus, or probably second biggest. Consolidation and financial instruments. These are kind of the biggest topics that we have. As I told, from today onwards, we'll be touching upon all the big ticket topics, which will take some time to cover. You cannot cover them in 1 or 2 days. It will take, like this topic will take easily 5 to 6 days. Consolidation also easy 5-6 days. Then Ind AS 115, Ind AS 116, all this also. We'll be doing all the big ticket topics. The intention, as I told, before your individual filing, tax filing season starts, right? I want to be done with majority of the topics so that I know that some of you may get a little busy post July endish. So that's our coverage ka mannerisms. Okay. All right. So let's get started. Financial instruments. Now this was not at all there in our CA intermediate. It's entirely a new topic, an Ind AS, totally Ind AS topic. Fine. So before we start this topic, let's probably get ourselves acquainted as to why this particular topic was introduced. Sir, this is not Ind AS, sir. This is a topic, sir. No, sir. This is also Ind AS driven topic only. Here we don't have one Ind AS, we have 3 Ind AS. Financial instruments, if you cover, you will be covering these 3 Ind AS. I'll come to that in a bit, right? So, before this particular we start the meaning and the chapter ka contents, let's understand the background. Why was the standard introduced? Okay. 1. Now, people, let's take our old 11th grade or 12th grade balance sheet. You know, we used to prepare balance sheet in this format. Life was so easy in 11th and 12th, no? So, draw one line, no? Line modify inside the class also, line modify outside the class also. Yeah, life was very, very simple, correct? Now, let's take the balance sheet in this format. Now, we used to show equity share capital, reserves and surplus, some non-current liability like debentures, current liabilities like creditors, bills payable. On the other side, property, plant and equipments, intangible asset, and some current assets. Correct, sir? You could have more components. I've just written them for illustrative purpose. Now, if you think about it, for PP, we have any Ind AS? Yeah, we have Ind AS 16. For intangible assets, we have Ind AS 38. What about current assets? Okay, you may not know Ind AS. Is there any accounting standard? Have you studied any accounting standard? We talked about how debtor should be valued, cash should be valued, bill receivable should be valued, prepaid expense should be valued. No. Okay. What about accounting standard or Ind AS for equity share capital, reserves and surplus, debentures, bank loan, creditors and all? All those are also important, no? Right? So about all this also, there could be a lot of drama. Like when you take a bank loan, you may do debt restructuring. Some of you do bank audits. Right? Loan ka interest rate may change, loan ka term may increase, it may reduce. Like this, a lot of things can happen with respect to the current liabilities and non-current liability also. Don't you think we needed an Ind AS which targets these question mark? Those components for which we have put question mark, don't you think we need an Ind AS which suggests the guidance for their valuation also? Yes. So that is where financial instruments came into picture. So for what and all we have put question mark now, no, all that question mark will get covered under financial instruments for a topic. That's the background behind this particular standard. Okay, sir. All right. Now moving along. Now this is also, it's a numerical topic, people. Usually, like you have a lot of numerical questions over here. But before we start the number questions, we need to be comfortable with the terminologies and certain provisions. So in the today's sessions, we'll get ourselves comfortable with those terminologies and some small case-based question. So if time permits, 1 or 2 big numerical question we will take, else they will start from tomorrow onwards. Okay. But without these provisions, you will not be able to solve those big questions. Fine. Okay. So let's get started. First, meaning. Sir, what does financial instruments mean? What is the meaning of financial instrument? Financial instrument means simply it is a contract. It is a contract. It gives rise to financial asset to one entity. Because of that contract, it will give rise to what? Financial asset to one entity financial liability or equity to another entity. Once more, financial instrument is basically a contract. Because of that contract, for one entity, what will get created? Financial asset. For another entity, what will get created? Either a financial liability will get created or equity will get created. Like if I purchase the goods from Chandu or Chandu? Chandu is okay. If I purchase the goods from Chandu for me is a creditor. For Chandu, I am a debtor. Yes or no? So if it's a financial asset for one entity, for another entity, it will be same or ulta. That will be financial liability, or it could also be a equity. Such a contract only we call it as financial instruments. Fine, sir. Now, what is financial asset? What is financial liability? What is equity? That is what we're going to learn next. Leave that. One by one we will go. Okay. Now, did we get it? Once again, what is that? Financial instrument is simply a contract that gives rise to financial assets to one entity, and it will create either a financial liability or equity to another entity. Okay. That means something which does not come as part of contract is not a financial instrument. If you want to apply financial instrument to a standard, there has to be a contract. If it is not coming due to a contract then it will not attract financial instruments ka standard. Yes, sir. Like income tax payable to the government. Income tax payable to the government is also a liability. Right? Is income tax a contractual liability or a statutory liability? Do we have any contract with our government of India saying I will pay this much tax? No. So these are statutory obligations. So income tax obligation is not a financial instrument because it is not arising due to a contract. Point number one. Are we comfortable, sir? No need to study all of this. I've just summarized what and all you need in the pointers there. So like this if you know, then it's first para is done. Meaning portion is done. Can I get to the next one? Yes, sir. Okay. Next, now we need to know what is a financial asset, what is a financial liability, what is equity. So one by one we will go. First is what? Financial asset. Fancy name. Financial asset means anything to do with cash. In simple common language, financial asset means what, sir? Anything that is related to cash. Okay, is a financial asset. Now you tell me, we will have cash in hand. Is cash in hand a financial asset? I told financial asset means anything related to cash. Is cash a financial asset? Of course. Cash is obviously related to cash only, right? So cash in hand is an example of financial asset. What about cash in bank? That is also what do you keep at bank? Cash only, So that means, is it related to cash? Yes. So the first component of financial asset is what, sir? Cash. Cash including what? Bank deposits. So if you have any cash in hand, cash at the bank, that is an example or that is a component of financial asset. That's the first one. Fine. Second one, equity instruments of another entity. Equity instrument of other entity. Meaning, if I buy, let's say I am an entity, ArivuPro. If we purchase Reliance ka shares, if we purchase Reliance ka equity shares as an investment, that investment is also what? Financial asset, specifically included in the definition. Because you remember, you had accounting standard 13 in your CA intermediate, we talked about investment. Here, investments are accounted under which standard? Financial instruments wala standard. Okay. In fact, investment can be accounted under 4 Ind AS. What is that? I'll tell you maybe tomorrow or day after class. For the time being, we will say investments are accounted as per which standard? Financial instruments wala standard. I will modify that as we know a little more information. Okay, sir. That's the second definition. What is that? Equity instruments of another entity. Or in simple language, if you buy equity shares of another company, it is a financial asset. Third one, it's a contract or financial asset. If you have any contractual right to receive, cash or any other financial asset, then such a contract is also financial asset. Once more, what is the third one again? If you have any contractual right to receive cash or any other financial asset, such a contractual right also becomes financial asset. Very simple. Fancy name, meaning is very, very simple. Suppose I have sold the goods to Jayant. How much value? 10 lakh. Correct? At 3 months credit. For 3 months, credit. That means I will collect the money. I have a contractual right to receive how much money from Jayant? 10 lakh. Within how many months? 3 months. I mean, Jayant is my debtor, no? And debtor is also financial asset. Debtor is also financial asset. Why? Because from the debtor, I told financial asset means anything to do with cash. From debtor, what will we receive? Cash. So instead of saying debtor or bill receivable is financial asset, they gave a fancy term. What is that fancy term? Contractual right to receive cash. From debtors, bill receivable and all, we have a contractual right to receive cash. Hence, they are also financial asset. Correct, sir? And now Jayant may tell, how much I have to collect from Jayant? 10 lakh. Now Jayant is saying, cash problem, Prabhu. I don't have a cash. Take my company ka equity shares. Take, Jayant is telling 10 lakh he will not give me cash. He will give his company ka equity shares. Right? That means his company ka equity shares I have received. Then what is that? Equity instruments of another entity is a financial asset. That is what this point is trying to say. A contractual right to receive either cash or any other financial asset. Or any other financial asset. Meaning instead of paying cash, if the Jayant gives me his company ka equity shares, right? That is also financial asset. Comfortable, Sarji? Once more or okay so far? Any confusion? No? Okay. Fourth one is a contractual right where we will exchange financial asset, financial liability under favorable condition. Once more. A contract where we will exchange financial asset, financial liability under favorable condition. Like what is that? Again, a fancy term, meaning is very simple. Let's understand this with the help of a small example. Sir, I have a creditor to whom I have to pay how much I assume? 10,000. I have to pay my creditor how much? 10,000. I have a bill receivable worth 9,000. Now you know bill receivable is endorsable. It's an negotiable instrument, right? You can pass it on. Whoever holds the bill receivable gets the money. Currently, who's holding bill receivable? I am holding. And what is the bill receivable ka value? 9,000. But at the same time, I need to pay my creditor how much? 10,000. Okay, sir. Now, 1 second, hang on. Now, bill receivable is a financial asset. Do you agree with me? Bill receivable is a financial asset. Do you agree? Why? Because we have a contractual right to receive cash. From bill receivable, we will receive cash. Anything related to cash, what I told? Financial asset. So, bill receivable is a financial asset. From creditor, we have a contractual right to receive cash or obligation to pay cash. From creditor, we will receive cash or we have obligation to pay cash. I mean, this is an asset or liability. That means creditor is an example of what? Financial asset or financial liability? Financial liability. Understood? More about financial liability also we will talk. But in this example, are you able to decode? One is a financial asset, another is a financial liability. Okay, na, Sarji? Now, we told our creditor, we have to pay creditor how much? 10,000. We told our creditor, we don't have cash, we have bill receivable worth 9,000. Do you want it? Creditor told, no problem, give it. We told our creditor, we don't have cash, but we have a bill receivable which is worth how much? 9,000. We asked the creditor, are you comfortable? Instead of cash, can you take a bill receivable? Creditor told, no problem, give it. Now, sad scenario this is or happy case for us? Sad or happy? Happy, how? Sir, I have to pay the creditor how much? 10,000. But I am giving the bill receivable only worth 9K. So, I paid more or I paid less. So, this is unfavorable or favorable for me? Such a contract, if you have any contract to exchange financial asset, financial liability, if you have made a contract to exchange financial asset with financial liability, under what conditions? Favorable condition. Okay. Then such a contract also is what's a financial asset. You may not see all this practically much, but just see. But that is also included in financial asset ka definition. Did we understand this now, people? So if it is unfavorable means what to do? Next definition, it will come. One by one we will go. Let's not overthink over here. Okay, everything, whatever is doubts coming in your mind will be answered, but one step at a time. So far we have discussed 4 things. Another one is derivative. Another one is Derivative we'll do it as a separate accounting, maybe fourth day or whatever. Fourth or fifth day it will come. Last day maybe it will come derivative. For the time being, don't worry about derivative. Derivative could be financial asset or it could also be financial liability depending on some circumstance. What is that? We will discuss at the end. Don't worry about that at all. So 5 components of financial asset. Tell me people, let's see. Cash is an example of financial asset. Then equity instruments of another entity, meaning if you have purchased equity shares of an other company as an investment, that is also financial asset. Third one, a contractual right to receive cash or any other financial asset from another entity. Such a contractual right is also financial asset. Fourth one, exchanging financial asset with financial liability under favorable condition. Last one, derivative. These are the simple components of financial assets. Any doubt in any component so far, people? Other than derivative, rest everything is okay. Pakka? Online also pakka? On this we will go slowly, the meaning go. So online also keep responding to me that things are okay, all fine or no, any doubts, so whatever. Just keep the communication two-way, people. Now online, can I move forward? No problem, right? Okay, so let's go for, let's understand this a little bit. All right, let me give you this example. You answer this. Now that you know, someone is saying, Anu is saying, sir, can you revise once again? Sure. What is the topic name? Financial instruments. Okay. Financial instrument is simply a contract. Because of that contract, to one entity, what will get created? Financial asset. To another different entity, what will get created? Either a financial liability or a equity. That's the first thing. But to apply financial instrument, there should be a contract. Something that does not come as part of contract is not a financial asset or financial liability or whatever. Like your statutory obligations like income tax and all is not a financial instrument. Okay, then we discussed financial asset ka definition. Financial asset means, in simple language, anything to do with cash. So first component of financial asset is cash. Cash including bank deposits. Second one, equity shares of another company if you have purchased as an investment. That is also financial asset. Third one, a contractual right to receive cash or any other financial asset. From our debtor, we have a contractual right to receive cash. Same from bill receivable. So they are financial asset. Fourth one, if you have any contract wherein you will exchange financial asset with financial liability under favorable condition. Favorable condition means you're not paying more, you're paying less. Such a contract also becomes financial asset. Last one is derivative. Derivative not yet discussed. In the future, maybe we will discuss. Okay, Anu, Vignesh or Vignesh. So you are a macha or a machi? Vignesh looks like a Tamil name according to me. Is it right? Sorry? What? Where are you from, Anu? What should I tell you? Okay, no problem. No, just kidding. Because I have observed that here, I think the G here will become like, somewhat like a K in Tamil is what I've observed in few cases. Chennai only, see? Rahul becomes Ragul there. Vignesh becomes Vignesh. I've seen a little bit of that differences between Karnataka and Tamil Nadu there. So good. Okay, so you are saying you are a machi. Okay, good morning, machi. Okay. So now, glad to know. Next, some examples I will call it out. You tell me whether it is a financial asset or not. Is PP a financial asset? Owner-occupied property. Okay, I'll give you all the list. Owner-occupied property, investment property, intangible assets. Are these financial assets? Are these financial assets? No, why? He's saying, sir, if it is financial instrument, it will come in this Ind AS, sir. We already covered them under other Ind AS, so it can't be financial instrument. Now, Jayant used his kidney. Okay. Or, yes, he's right only. Obviously, it is not financial asset because I said in simple term, financial asset means something to do with cash. Now, if you have debtor worth 10 lakh, if we have debtor worth 10 lakh, should we have to do anything? No, automatically debtor will pay us. 10 lakh on the due date. We just need to follow up. Correct, no? Right? But if you have 1 crore worth PP, will we automatically get cash or we have to do some extra activity? If you have 1 crore worth PP means automatically you will not get cash. Either you have to use it or you have to sell it. Just by holding PP, you won't get cash. Just by holding debtor, you will get cash. Just by holding PP, investment or rather intangible asset, you don't get cash. Hence, PPs, owner occupied property, investment property, intangible assets are not financial assets. Meaning, did we understand? Everybody comfortable? Okay. ROU. ROU means we have studied this. Whenever you take an asset on lease, the lessee, I told, we has to show two things, ROU and lease liability. ROU also is not a financial asset. ROU means right of use asset account. ROU is also not a financial asset because just by holding ROU, will lessee get the benefit or lessee has to use that asset? Lessee has to use that asset to generate some cash. Hence, ROU is not a financial asset. Comfortable, sir? Correct. So that way, investment also should not be a financial asset, no sir? If you buy equity shares of another Infosys, automatically you may not get cash. That's the reason they included specifically in the definition. That's the reason they included specifically in the definition. Because if it was not included in definition, then it would have come out of financial asset and you would not have any standard for it. Investment is also, you need some standard, no? So to cover them under some standard, they included investment specifically under financial asset. Got it, sir? Understood, everybody? Next, prepaid expense. Is prepaid expense a financial asset? No, I'll only tell the answer. Prepaid expense is not a financial asset. You give me the justification. Why is prepaid expense not a financial asset? Prepaid salary. I paid some salary to my employee. Next month ka salary I paid this month only. So it's a prepaid expense. It's an asset. But is it a financial asset? No. Why? Yes, Macha?
You won't get cash, but instead of cash, you will get some.
Perfect. Perfect. Sir, financial asset, I told, if you don't overthink. Easy way to decode financial asset is what? Something to do with cash. From prepaid expense, you will get cash. No, you already paid cash. Now, next month ka salary, if you pay to the employee this month only, from that employee, what will you get? Not cash, but a service. Hence, it is not a financial asset. Because you're not getting cash here, you're getting a service. Same with respect to advance given to creditor also. If you give any advance, that is also current asset, no? So, if you have given any advance to creditor means, from that creditor, what will we get? Will we get cash back or we will get goods? We'll get some goods or maybe some service. Hence, it is not a financial asset. That is what this para is trying to. Now, come on, tell you. So, this not required, just this much is enough. I know, people. Sometimes this also can come for 1 mark, but rare. They are not that popular in examination. Okay. So, I'm using the word popular. I say sometimes we'll radically revamp the paper. So, it's better to know everything. We have AFM example now. Yeah, something out of the blue also can come. So, yes, that's the reason I am a big believer that don't skip things. Because you don't know when one attempt may tamar slap you'll get from ICA. So better to prepare everything so that even if 30-40 marks comes as bouncer in one attempt, still we will be able to attempt that 60 and get 50-55. When too many things has come as bouncer, the other things come, valuation will be little easy, lenient. So they will give you good marks. So that's where you need to play into picture. But no matter what, I still feel around 60 to 70 marks. Still, I feel every attempt, no matter how much comes as bouncer, 60 to 70, I still feel will be from study material, RTPs, MTPs, last 2-3 attempts. So if you are covered with this much though, no matter how tough the exam comes, in my view, this much you can attempt. And still end up scoring 55-60, even the worst of worst attempts. That's my personal feeling. Okay. All right. Next. Now let's go over. Now that we know financial asset ka definition, we have some small case studies. We don't have to do anything, just one-liner answer. Read the data and give me the answer. Look at this. Z Limited, the company, they have sold the goods to a customer on credit. Goods carried are in large containers for delivery to the dealer's destination. Okay. So maybe we are putting that goods in some drum and transporting. Okay, some container. all the dealers are required to deposit a fixed amount of 10,000 as security for the container. Now that goods, no, we are putting in container, one drum, and sending and dispatching. The drum has value, no. Now we want that particular dealers to return the drum to us. Okay. So if they don't return, it will be a loss for us, no. So we have collected what from them? Security deposit. Okay. Which is returned only when the contract with the company terminates. That security deposit we will return back when our contract terminates. The security deposit carry how much interest rate? 8%. On that security deposit, we are also paying interest. Usually it will be interest free, but here we are giving interest. But interest is payable only when the contract terminates. If the containers are returned by the dealers in a broken condition or damage caused, then appropriate adjustments will be made from the deposit. So if there is any damage, we will reduce from the deposit and give the balance amount. Fine, people. Now, Z Limited is paying the deposit or receiving the deposit? Z Limited is the company. We are selling the goods to the customers on credit. The goods are carried in the containers for delivery to the dealer's destination. So we are selling the goods, no? So we are sending the goods in container. So that means we are paying the deposit or collecting the deposit. Z Limited is collecting the deposit from the dealers. Now you think from whose perspective they are asking what? How such deposit should be treated in Z Limited books or dealer books? In dealer books they are asking. Sir, we are not dealers, we are sellers. We have collected security deposit. But what has a dealer done? They have given the security deposit. Now, security advance given basically. For a dealer perspective, it's a deposit given or advance given. Now, you tell me, for a dealer, is this a financial asset? Is this a financial asset? Financial asset means something to do with cash. When the contract terminates, what will happen? Automatically dealer will collect the cash. Should they have to do anything or they will get the cash? That means they have a contractual right. The dealers have a contractual right to receive cash. If you have any contractual right to receive cash, automatically it is what? Financial asset. So for a dealer, this is security deposit given as a financial asset. If it is financial asset, is the standard not applicable or applicable? It is applicable. That's all his answer. No need to write story, all this. It's the first few questions. No, so ICA is given some explanation. This much what I've written is more than enough. All these are not that very important questions for exam. But we have started the topic. No, so it's good to know a little more better understanding with respect to the definition. So small cases. Like this, you tell me the other things now. A Limited issues bond for a principal amount of CU 1000 per bond. Actually, the CU is currency. It should be INR. Maybe they have copy pasted this book from ACC or some other book where maybe they have copy pasted. So the currency they forgot to change. Leave that. It's okay. So what is the value of that bond, people? We'll take it as 1000 rupees. It's okay. The terms of the bond require annual payments in perpetuity at a stated interest rate of 8% applied to the principal amount of 1000. On these bonds or debentures, how much interest company should pay? 8% in perpetuity. Perpetuity means there is no life. It's an irredeemable debentures. It will go on forever. Assuming 8% is market rate when it was issued, issuer assumes the contractual obligation to make a future interest payments having fair value, blah, 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 blah. We are saying company will pay interest. Obviously, you have to pay interest. That is okay. Evaluate the financial instrument. They are saying what is the nature of this financial instrument in the hands of both holder and the issuer. Whoever is issuing bond, for them, what is it? Whoever have purchased this bond, for them, what it is? Holder is what? An investor. Issuer is the company issuing debentures. Now think from the investor perspective. They have purchased bonds. They have purchased a bond. On these bond, investor will pay interest or receive interest. How much interest? 8%. That means investor has a contractual right to receive. Should investor do anything? Or periodically investor will get cash. Periodically investor will get cash. At what rate? 8%. Maybe monthly, maybe quarterly, maybe yearly as per the contract. So investor has what here? A contractual right to receive cash. If you have any contractual right to receive cash, automatically it is what? Financial asset. Correct, sir? Any problem? Now think from company who has issued this bond. They have a contractual right to receive cash or contractual obligation to pay cash? The company which has issued the bond or debentures, they have to pay cash. If you have a contractual right to receive cash means financial asset. If you have an obligation to pay cash means, a contractual obligation to pay cash means financial liability. So for a holder, it's a financial asset. For the issuer, it's a financial liability. Clear, sir? That's all it is. Now, I think, is our understanding with respect to financial asset clear? Everybody? No, financial instrument means either it will create FA to one entity or financial liability or equity to another entity. So, FA we have covered. Financial asset, what it is, we have covered. Now, similarly, we'll go for FL. FL means financial liability. Next, what is equity? Like this. Then we will go for some measurement basis of financial asset and then we can start the problem like this. First, this is the order. Done, sir? No need to worry about the extra fittings which ICI has written. One line answer, all these are. Only concentrate on that much. No need to, no extra mirch masala required. Next, financial liability. Now people, if you know financial asset ka definition, you can tell me financial liability ka definition. Try. What was the first component of financial asset? Cash. Can cash be a liability of people? Cut that off. Second one, if you put equity instruments of an other entity, meaning if you buy equity shares of another company. Sir, if you buy equity shares of another company, can it be a liability or it's an asset only? So cut off that. So first two components of financial asset you cut off. Remaining is you need to bring it up. Their third component of financial asset was what? A contractual right to receive cash or any other financial asset. So here modify. Financial liability means it's a contractual right or contractual obligation. Contractual obligation to receive cash or pay cash. Pay cash, or you can also settle. Should you settle all the liability in cash only or any other FA is also okay? You can also settle in other assets. Like creditor in my previous example, you did not pay cash, you gave bill receivable. Correct? So that means what is the definition? Tell me once, or first component you tell me. Financial liability means we have a contractual obligation to pay cash or any other financial asset. First one. Next, there it was exchanging financial asset, financial liability under favorable condition. Here, same. If you have any contract where you are exchanging financial asset, financial liability under unfavorable condition, that becomes a financial liability. Ulta example. Suppose I have to pay the creditor how much? 10,000. I have bill receivable worth 11,000. I don't have cash. I told my creditor, instead of paying cash, I will endorse my bill receivable to you. We will give bill receivable to creditor. Creditor told no problem, give it. But we told the creditor our bill receivable is worth 11,000. Creditor is saying no change policy. We don't have change policy. If you are okay, give me bill receivable. Otherwise, give me cash. That means I have to give how much bill receivable to creditor? 11. But I have to pay my creditor only 10. Am I getting this balance 1,000 bank or goinda? Goinda. I mean, this is favorable for me or unfavorable for me? Unfavorable. So if I have such contract to do this exchange, this contract becomes a financial liability. Any problem? Any problem or okay? There you wrote what in financial asset? Derivative. Derivative could either be a financial asset or it could be financial liability. I know people. So here also it will come. Yes, sir. 3 components we have done. There is one more called issuing variable number of equity shares. On non-derivative contract where we will issue variable number of equity shares. This you might not have understand now. Let's do a thing. Let's put this on hold. After I cover equity, I'll come back to this. In fact, if I don't come back also, this gets covered automatically. Okay, now I'll talk about this in a bit. Okay, summarize once for me now. Let's see. Financial liability ka components. Contractual obligation. A contractual obligation to pay cash or any other financial asset. Then exchange financial asset, financial liability under unfavorable condition. Derivative. Then where issuing, if you are issuing variable number of equity shares, your own company equity shares, but you are issuing what? Fixed or variable? Variable. Then that such a contract also becomes financial liability. Don't worry about this portion for the time being. In about 10 minutes, it will get sorted. But till then, let it be on hold. Can I move on to the next one? Do you want me to send this file before the class? If you think it helps, I'll send it. I don't mind. Or after class means after class. Online, how do you want? Because some of you are noting it down, so I'm asking. So if you have a file where you can refer, would you feel comfortable psychologically? If you feel psychologically comfortable, I don't mind sending the file before also. How do you want it? After is only okay, na? You still prefer to write some things on your notebook, ah? Okay, no worries. No problem. That we will take it. Online is saying online has become Devru. God, they are not commenting only. No issues. Question number 3. I'm glad that they've woken up and woken out of their bed and watching the class. 6 o'clock, that itself is luxury, especially Bengaluru atmosphere and all. Yeah, I think in Chennai automatically you wake up at 5. What hot first day I was so impressed, We're full pakka Bangalore weather in Chennai. First day. Full cloudy, full breezy. We were like, so nice. So cute, so romantic. Next day, from where the sun came, it never went only. Full churr. We are sitting in cab full churr. Yeah. So that way I think we used to automatically wake up at 5. Absolutely no issues. But I think in Bengaluru, weather waking up at 6 o'clock, 5 o'clock and all is, it takes some commitment. Yeah. So yeah, kudos to you people for waking up and coming to class. Glad. Okay. So let's go for question number 3 and see what we can learn from this question. A Limited makes a borrowing of 10 lakh from RBC Bank. We have taken a loan from bank. Sir, if you have taken a loan from bank, we have a contractual obligation to pay cash. Because periodically we have to repay interest also principal. So loan taken is what? Financial liability, because we have a contractual obligation to pay cash. Correct? So how much loan we have taken? 10 lakh. How much is the interest payable? 12%. Annually you need to pay interest. Okay. Now company defaults at the end of 5th year. And in fact, this is a bullet repayment of 10 lakh. Bullet repayment means principal you will pay at the end. Okay, but interest you have to pay on an annual basis. Bullet repayment means that only. Whatever principal you take, you are not repaying annually, you will repay at the end. At the end of the loan term, you will repay. Okay, maybe the loan term is 5 years. Now, company defaults at the end of 5th year. At the end of 5th year, there is some default. Consequently, a rescheduling of the payment was made at the beginning of 6th year onward. So, now this we call it as debt restructuring. There is a CDR cell also in banks which does all this, especially if it's a big loan. Not done bank audits, no problem. Okay. The company is required to pay 13 lakh now at the end of 6th year. We had to pay how much money, people? Principal, we had to repay 10 lakh at the end of 5th year. Okay, now because we defaulted, bank is asking how much? 13 lakh in total as one-time settlement. In lieu of default of payments made earlier. Because we made a default in which year? 5th year ending. Now bank is saying in 6th year, you pay me 13 lakh rupees. Okay, now they are saying this is a financial liability and how you should account. Okay, look at this, people. Of course, loan taken is a financial liability. We don't even have to read further. Okay, we can stop there also. You can also go for, they are specifically asking about this one-time settlement also. We have done some exchange, no? So analyze the differential amount to be exchanged. Okay, answer this. Is this a financial liability? Of course, loan taken is a financial liability. Correct? That is sorted. Now they're specifically asking, analyze the differential amount to be exchanged for one-time settlement. Now, loan taken is a financial liability. That loan you have settled by paying what? How much? 13 lakh. 13 lakh what? Cash. Is cash a financial asset? This cash financial asset you are settling, you are exchanging with financial liability. Okay. Now we are doing an exchange. Financial liability and financial asset you are netting off by exchanging them. That exchange ka difference, what you should record is what they are specifically asking. Now you know this. Whenever you exchange financial asset with financial liability, if it is favorable exchange, if it's a favorable exchange, financial asset. Unfavorable exchange, financial liability. So let's first find out whether we are paying more due to default or are we paying less. Very simple. How much loan have you taken? 10 lakh. Okay. How much interest you have to pay? 12%. Clear, sir? And now, 5th year. First 4 years, everything was smooth. Which year we defaulted? 5th year. Calculate how much is 5th year interest we need to pay. Fifth year, how much interest we need to pay? 1,20,000. Or maybe straight away can we tell 10 lakh principal you need to pay. For fifth year, you need to pay how much interest? 12%. 10 lakh at 12% is how much? 1,20,000. Fifth year, did you pay or you defaulted? You defaulted principal also, you defaulted interest also. That means how much now you need to pay to the banker? 11,20,000. 10 lakh principal plus 1,20,000 interest. So sixth year, will you calculate the interest on 10 lakh or 11,20,000? Sixth year, settlement is happening in fifth year now or sixth year? Sixth year, now will you calculate interest on 10 lakh or 11,20,000? 11,20,000. So calculate how much is that? This will be your year 6 ka interest. How much is this amount? 12,54,400. What was year 5 ka interest? Year 5 ka interest will be calculated on 10 lakh, which is 1,20,000. What is the year 5 ka principal you have to pay? 10 lakh. That means totally now how much you need to pay? 10 lakh principal plus 2 years ka interest. Add them. How much are you getting? You should be getting 12,54,500. Correct, sir? No, I think this number is wrong. I think this fifth year ka interest is wrong. Sixth year ka. Tell me that amount again. 1,34,400. Adding all of it, how much are you getting? 12,54,400. Correct. That's what I've just written in one line over. 10 lakh plus 12% plus 12%, which is nothing but your 12,54,400. Correct, Ajay? So that means as per our original contract, how much we need to pay to the banker? 12,54,400 because interest is 12% now. Correct? Instead of now the settlement happening in fifth year, settlement is happening in sixth year. So if you actually calculate as per the original contract terms, settlement amount should be 12,54,400. But are we settling 12,54,400 or 13 lakh? We are paying, the settlement value is 13 lakh. Okay, now you tell me, is this a favorable, from our perspective, not banker, from our perspective, is this a favorable exchange or unfavorable? Unfavorable exchange. So obviously this is what difference should be. You will record it as a financial asset or financial liability. Financial liability. How to account for all this, we will talk about it in the second year. Don't worry about all this. Okay, there's some extra provisions also which comes in. Now it is just we are still playing around the definition. Got it, everybody? The differential value. Since you're paying extra amount as a difference, that extra amount becomes unfavorable for us. So the unfavorable exchange is accounted as a financial liability. Don't worry about journal entry and all over here. I know that some of you, the moment we write something, your mind runs into journal entry and all. It's not straightforward journal entry. There are some methods to value financial asset and financial liability. We need to discuss all that and then only journal entry will come. So if your mind is running towards journal entry, stop. As we proceed a little further today, we will discuss the method and then the problem will start. No worry, it's a proper numerical chapter only. A lot of good numerical questions are there. So this is done according to me. Third one. Can I move on to the next? And now, before I do fourth question, I'll do of equity ka definition once. Online so far, give me a response. Are we okay, everybody? Till now, whatever we have covered, are we comfortable? Okay, thank you. All right, moving forward. So far we have covered financial asset, financial liability. One more is there. What is that? Equity. Now we are studying a little bit about equity. Okay. We have written a lot of pointers over here. All that not required. I've just summarized it into few smaller words and components, and this is good enough. And here you don't have to mug up the things, okay? Because they will not, again, according to me, highly doubtful that they will say explain financial asset, explain financial liability. All those questions, according to me, are very, very doubtful. They will give you a case study through which you may have to identify whether it's a financial asset, liability or equity. So for that, you just need to know it. Okay, as long as you are able to come to that conclusion, it is enough. Fine. Okay, but if you still remember it, that is awesome. Okay. All right. Now look at this. Equity. Sir, equity shares ka definition we have studied in our inter also. Anybody remembers? What do you mean by equity shares? Equity shares. Ownership. Yeah, obviously. By owning equity shares, we become the owners of the company. Correct. But we used to use a certain definition. Anybody remembers that? equity is basically an instrument. Equity shares or equity is basically an instrument that gives the investor or holder the right over the assets of the company or net assets of the company. Net assets of the company. If you buy equity shares, let's say you buy equity shares of ArivuPro, right? Will you get share over the assets of ArivuPro? No. If ArivuPro by chance shuts down, Shantam Papam, no. Okay. Just an example. If the company shuts down, then what we will do? Whatever assets we will have, we will sell. And whatever money we will get, straight away we will pay to equity shareholders. No, first we will have to settle all the liability. From the assets, first you need to settle all the liabilities. After that, whatever money remains will be given off to equity shareholders. Hence, we say equity is basically an instrument which gives the holder or an investor right over assets of the company or net assets of the company. Or you can also say equity is an instrument that gives the holder the right over assets of the company, but after deducting all the liability. After deducting all the liability, whatever asset remains only we call it as net assets. That's the meaning. Clear, sir? And now, you tell me, if ArivuPro, if we have issued equity shares to you, if ArivuPro, suppose you are a shareholder of an ArivuPro, we have issued equity shares to you, right? That means we have collected money from you and we have given you the share certificate, correct? ArivuPro, will you have any, as ArivuPro, the company, we will have any obligation to pay you your money back? Will equity shares come with any obligation or it's permanent capital? It's a permanent capital. Whenever a company issues equity shares, they have no obligation to pay cash. Now, ArivuPro, if we issue debentures, let's say the term is 10 years. That means by the end of 10th year, ArivuPro will have an obligation to pay cash. Correct? But if ArivuPro, if we are issuing equity shares will have any term or it's a permanent capital. Whenever company issues equity shares, there is no obligation to pay principal also. There is no obligation to pay dividend also. Absolutely no obligation is there. Correct, sir? That's the second point I've written here. So equity ka one more feature is there is no obligation to pay cash or anything else. If company wants, they may give dividend to equity shareholders, or a company may decide not to give dividend. Totally company ka choice. That's what I'm saying, trying to say in the second point. There is no obligation. Done, sir. Third one, equity we say generally is non-puttable. What is this puttable? I'll talk about it in the very next. Puttable instrument is the next concept. I'll talk about this. Let me put this on hold for the time being. So equity shares are what? They are not puttable. They are non-puttable. So far that much is good enough. Now, these are all some features. All these are not much relevant for our examination, to be honest. One component could be relevant for our examination. If at all a question can come, it can come for 1 or 2 marks based on this concept. What is that is? Sir, Ind AS says, if you want to classify something as equity, fixed to fixed test should be passed. Once more, what is it? If you want to show something as equity, F to F test should be passed. F to F means fixed to fixed test should be passed. Okay. So what is this fixed to fixed test, sir? Very simple. By issuing equity shares, how much money company collects, that should be fixed. By issuing equity shares, how much money company will collect, that should be fixed. How many equity shares are issued, that should also be fixed. Basically, the consideration and the number of equity shares, both should be fixed. If one of them becomes variable means, boss, it is not equity, it becomes financial liability. That is what in our previous case mein financial liability ka definition had. Delivering variable number of equity shares. For it to be equity, what should be fixed? What should be there? Fixed to fixed has to be passed. Both consideration and the number of equity shares should be fixed. If one of the component varies means it is not equity, automatically it will become what? Financial liability. Hence that component is included in financial liability definition. Are we comfortable with this, everybody? We have some case studies based on this also. No need to worry about that. But currently, is the meaning making sense? Where it went here. Are we okay with this? Now can we take one question? One or two questions just to see how it works. Okay, maybe we'll take up maybe this. So check this. Target Limited took a borrowing from Z Limited. Question number 4 we had skipped now, so we are just looking at that. Target Limited has taken a borrowing loan from Z Limited for 10 lakh. Okay. Loan taken is what, sir? Financial liability, right? Sir, if loan taken is a financial liability, loan given is a... When you take a loan, we have a contractual obligation to pay cash. So it's a financial liability. But when you give a loan, we have a contractual right to receive cash. A contractual right to receive cash is a financial asset. Clear? Okay. So since target has taken a loan, for the target it will be financial liability. For Z it should be a financial asset. So far that's the thing. How much is the loan amount? 10 lakh. Now Z enters into an arrangement. Z has entered into an arrangement with the target for settlement of loan. Settlement of loan. Ideally loan should be settled by what? Cash. Correct? Because you took the loan in cash. Ideally, the loan is also settled in cash. Now, here they made an arrangement saying that the loan will be settled against issue of certain number of equity shares of target. So, target is telling Z, oh, I will not repay this 10 lakh in cash. I will repay this 10 lakh through my company ka equity shares. Correct, sir? Yes, sir. So, that means target has to issue equity shares to Z in the arrangement. Are we comfortable? Target Limited, one company, they have to issue their own company ka equity shares to Z. Correct? Sir, if a company is issuing equity shares, for a company it is equity, financial liability, what it is? Equity shares issued is what? Equity or financial liability? Equity, correct? But there's one condition. What is that condition? For you to classify equity, F to F test should be passed. What is F to F? Fixed to fixed. What should be fixed? Consideration should be fixed. Number of equity shares should be fixed. Yes, sir. Now let's test that. Read the line once again. Target will issue for the settlement of loan certain number of equity shares. What number not given? Certain number of equity shares of target. Their own company ka equity shares they will issue whose value equals to 10 lakh. Okay. That means target is saying Z, oh, I will issue that many number of equity shares whose value is what equal to 10 lakh. And for this purpose, fair value per share shall be determined based on the market price of the shares. Okay, sir. Now you tell me, is the number of shares issued by target to Z Limited fixed or is it varying? It's varying. Why? Because the number of shares is based on the market price. Basically, target is telling Z, I will give you the shares. I will give you that number of shares whose value will be equal to what? 10 lakh. Okay, now use your common sense. Suppose on the settlement date, let's suppose the loan cut term is 5 years. Loan cut term is 5 years. That means target will issue the shares to Z now or after 5 years? After 5 years as settlement. Let's say after 5 years, the market value of equity shares is 100. Market value of the equity shares is how much? 100. Then how many shares will be issued? So totally how much we need to settle as loan? 10. 10 lakh we have to settle. How is this 10 lakh settled? By issuing equity shares. What is the value of one equity shares? Market value of assumed is 100. So how many shares will be issued? 10,000 shares. Clear, sir? Suppose the market value is 50. It's not 100. Market value could be anything, no, after 5 years. If it is 50, then will you issue 10,000 shares? How many shares will you issue? You have to give 10 lakh. You have to totally settle 10 lakh. How are you settling? By equity shares. What is the value of one equity shares? 50. So how many equity shares will you give? 20,000 equity shares. Now you tell me, is the number of shares issued fixed or variable? Variable. I mean, now will you classify this as a equity or financial liability? Financial liability. Why? Because number of shares is not fixed. That's what we are saying. It is not for you to classify it as equity, one test should pass. That's what I've written here. What test should pass? Fixed to fixed test should pass. Here fixed to fixed test is passing or failing. Number of equity shares issued over here is not fixed. Hence it is not equity. Therefore it is, what is the nature of this instrument? It's a financial liability. That is the answer. Only this much is good enough. Done, people. Basically, here you are using equity shares as a currency. Because based on the market value of the equity shares, number of equity shares given is also varying. So basically, in a way, you are using equity shares as a cash. Okay, instead of paying cash, you are using equity shares as a tool to settle it. Okay, that's a number there. Yes, people. And now let's go for the next question. Any doubt or okay? All one line answer. Nothing, no beyond that, nothing you need to break your head for. Okay, now look at this. And now, people, 1 minute before I take up the next question. Welcome to Ind AS world. In AS, if you remember your balance sheet ka first heading used to be equity and liabilities. Under that, shareholders funds. Under shareholders funds, share capital, and then reserves and surplus. Under shareholders funds, we used to show two things, or rather under share capital, we used to prepare note number 1 for share capital, and there used to be two types of share capitals. They are equity share capital, preference share capital. That's how we used to show in your CA intermediate till now. That's what you have done. In Ind AS, there is no more category called preference share capital. There is no more a category called preference share capital. Preference share capital is either shown as equity or it is shown as financial liability. Either preference shares will be accounted as equity or under financial liability, because common sense. Now think about it. When a company issues preference shares, but in India, I think we cannot issue irredeemable preference shares, right? Companies Act ka prohibition is there. Maximum we can issue for 20 years. Infrastructure company can go up to 30 years. All this we studied in our law, correct? So use your common sense. Again, Ind AS is basically based on your substance over legal form, reality based accounting. Now, if a company has issued 10 years preference shares, if a company has issued, let's say 10 years preference shares, so all the 10 years company has to pay dividend. Can company escape from dividend, or they have to compulsorily pay dividend? Compulsorily pay dividend. And 10th year, what will happen? Company will have an obligation to pay principal. Now, if you use your common sense, company has an obligation to pay dividend also. Company has an obligation to pay principal also. That means obviously it is what? Financial liability. So hence, don't show it as under shareholders funds, the share capital and all. Book it under where? Financial liability. Okay. By chance, if they say it is irredeemable preference shares, because India is IFRS. In India, we have prohibition. But in other countries, maybe there may not be prohibition. They may issue irredeemable preference shares. Suppose if you issue irredeemable preference shares and contract says dividend is discretionary. 2 points I made. What is that? Irredeemable preference shares. That means any term is there or permanent? Permanent. And dividend is compulsory or discretionary? Discretionary means company choice. Now use your common sense here. Company has an obligation to pay principal. No, it is irredeemable. It will go on forever. Company has an obligation to pay dividend or company choice? I mean, this is what? No obligation means now it is financial liability or equity. Based on the nature of preference shares and contract clause, preference shares either you will classify it as equity or as financial liability. There is no separate category for preference share capital here. Understood? What we discussed is clear with you. Now there are a couple of questions. They will give preference shares. Now you have to tell me whether those preference shares are in the nature of equity or will you classify it as financial liability. Can you tell me? Okay. With that in mind, let's read question number 5. Silver Limited issued irredeemable preference shares. Irredeemable. Underline that. Irredeemable means it is financial liability feature or equity feature. Equity feature with face value 10, no, but they have issued at a premium of 90. So issue price is 100. Okay. These shares you have to pay how much dividend? It's preference share. So how much preference dividend you need to pay? 8%. But however, dividend is paid only when Silver Limited declares dividend on equity shares. If dividend is given to equity shareholders, then only dividend will be given to preference shareholders. If dividend is not given to equity shareholders, dividend will not be given to preference shareholders also. Me telling or question? Question. Okay, now you have to analyze what is the nature of this preference shares, FL or equity, financial liability or equity. Equity, no obligation to pay principal because irredeemable. No obligation to pay dividend because dividend should be paid only when it is paid to the equity shareholders. If dividend is not paid to equity shareholders, dividend need not be paid to preference shareholders also. So this is obviously what? Equity. So there is no obligation to pay principal and dividend. Hence, the classification of this preference shares is equity. How to do accounting? Don't worry about all that. Just we are in the classification stage. This is over according to me. They've just given the story here. No need to story. This much is enough. Next one now. Next, now look at this. A Limited invests in compulsorily convertible preference shares. Preference shares only, but convertible preference shares. In case of convertible preference shares, principal will be repaid in cash or principal will get converted into equity shares. Equity shares. Yes, sir. Everybody so far good? Okay. It is issued by subsidiary company. Subsidiary company has issued some preference shares. Who purchased it? Parent company purchased it. And these are CCPS, meaning compulsorily convertible preference shares. Okay. And at what value was this preference shares issued? 1000. 10 is the face value, 990 is premium. Fair enough. Under the terms of this instrument, each CCPS will be compulsorily converted into one equity shares of B at the end of 5 years. So, on one preference shares, how many equity shares will you get? On one preference shares, you will get one equity share. So, that means number of equity shares issued, variable or fixed? Fixed. Comfortable? Okay. Such CCPS will carry how much dividend rate? 12%. But dividend is payable only at the discretion of B Limited. So, dividend is a compulsorily payment or option payment? Option payment. Now, first, does the company have an obligation to pay principal? No, because it is convertible preference shares. Does the company have an obligation to pay preference dividend or discretionary? Discretionary. Okay, na sir. That means no obligation to pay principal and dividend means it is FL or equity. And moreover, number of equity shares issued also is variable or fixed only. Fixed only. So that criteria also, everything is pointing towards which direction? Equity ka direction. That's all it is. Over answer. And in case you are wondering, I think in this topic, there might be some, I don't know, in regular, there might be some 70, 80 questions, maybe a little more than that. Don't freak out. Majority of the questions are like this. Because it's a new topic, no? ICA has given a lot of chin-to-pin-to case study questions. There are some overall 15 to 20 big questions. That much if you are doing more or less, till now, all the questions have come around that particular things. Fine, we'll get to that. Just don't freak out by looking at the number of questions. Okay? We'll take care of that. Now, sixth one is done now. Because we have a habit now, the moment we start a topic, immediately we'll start counting how many pages, so how many questions, so now you are flipping through, no problem. All right, maybe you didn't have that. After me telling, you started doing. Great, I will stop saying that next time then. See, it's like I already did the math, sir. You already told 5 to 6 days, so we thought that this will have too many questions. Correct. Easy only. It is just that we have a lot of small concepts. And small question. Each concept has a question and a lot of concepts are there. So yeah, it will take some time. But don't worry, manageable only. And it's a quite scoring topic only. Just a little lengthy, that's all. FR I still feel is a scoring subject, provided you cover the content and revise the content. The only drawback of FR is the volume, the sheer volume. It's definitely lengthy. As a teacher, I will only accept it, totally accept it. Definitely probably most lengthiest. Okay, but good. 1 week good only, because if you just cover it, 60, 65, 70, more than 70 also you can expect, provided you do the right kind of preparations and revisions. Right kind in a sense, daily revisions. That's what I mean. Hope you're doing it. Hope you're doing it. No, not happening. Are we doing the revisions? Don't look at me, sir. Yeah, please do that. All these are definitely lengthy things. You will not remember, people. Okay. In fact, in last batch, I did not give leave actually. For FR, we did it continuously for it was a regular batch, so it went on for almost 3.5 months. But then I felt that if I give 1 day break in between, at least you have an opportunity to recap whatever you have done in that 5 days or 6 days. And for FR, I feel that recap is required. That too on your own. Because See, we have taken multiple batches, so that means when I recap it, it will be at a little faster pace. But you are doing it for the first time, so you need a little extra time. So when you give a recap to yourself, in a way, you're not just revising, you're also studying it a little once more, in a little more detail. That is required. So kindly use that one day off, whatever we are giving, to, yeah, I know that you also want to sleep a little, enjoy, catch up with your girlfriend, boyfriend, friends, and all this drama also you want to do. Okay, do that. I'm not denying that, but also spend some 5 to 6 hours or how much ever time, at least to give a recap of that week what is done. That will increase the confidence in the paper, people. Okay, now look at this question number 7. No? A Limited, the issuer, they have issued preference shares to B. Okay. Those preference shares are redeemable at the end of 10th year. Redeemable means we need to pay. We have to pay principal in cash. So we have an obligation to pay cash. Which cash? Principal portion of cash. From the date of issue, and entitles the holder a cumulative dividend of 15% per annum. Did they say dividend is discretionary? No, they said dividend is commensurate with the credit risk of the profiler. They're saying dividend is correct compared to the market rate. So market rate is 15% and we are also offering 15%. Did they say in last two problems, they said dividend is discretionary or preference dividend is payable only if dividend to equity shareholders are paid. Like that they had mentioned. Any mention here or no mention? So that means what is it over here? The company issuing preference shares, they have an obligation to pay dividend also. They have an obligation to pay principal also. Yes, so obligation means equity or financial liability. We do have an obligation to pay dividend and principal, hence it is financial liability. That's all is this question. Done, sir. So with this financial instrument definition we have covered. Again, financial instrument is simply a contract which creates financial asset to one entity and financial liability or equity to another entity. So far, if you just check in 1 hour, we only discussed 3 components. FA, FL, equity. Only their meaning, and we have understood their meaning a little better through all the 7 questions so far, whatever we have done. Can I proceed further? Everybody? Okay. Next is puttable instruments. Sir, people, if you remember equity when we studied, there I said equities are generally non-puttable. That's what we had written here, if you remember. I'll show you if you want once again. And when we wrote equity features, we wrote equity generally are non-puttable. Now this portion we have not studied. That's what we are about to know a little more over here. Okay. One minute. I'll just see if there's any one more question. These two are okay. All right. I think we'll go in that order. No problem. Puttable instruments. Puttable instruments. Okay. Sir, what is this puttable instruments? Sometimes what happens, we will issue an instrument with a put option. We will issue an instrument with the put option. Whatever, it could be like equity shares, debentures, preferences, or whatever. Company will issue these sort of instrument along with one extra fittings called put option. What is this? Sir, if you studied AFM, you might know this, or if you have not studied, it's fine. Put means what? When you say put back, give back. So if you have issued any instrument with put option means, suppose I'm the company, I've issued equity shares, let's say to Yagnesh. I've issued equity shares to Yagnesh with put option. And the value of that equity shares is, let's say, 1 lakh rupees. Or 1 lakh shares. 1 lakh shares I've issued to Yagnesh with what option? Put option. How does this put option work is? Sir, generally on equity shares, you will not have any obligation. But the moment you issue something with put option, you can issue equity shares with put option, preference shares, debentures, whatever. Okay. All right. Now I have issued equity shares to Yagnesh under put option. If put option is given means Yagnesh will have a right, not company, not the issuer, but the holder. Not the issuer, not the issuing company, but the investor. Who is investor over here? Yagnesh. Yagnesh will have a right. What right? How many shares we issued to, I issued to him? 1 lakh. If Yagnesh wants, only if he wants, not an obligation, he has a right. Yagnesh has a right. If he wants this 1 lakh shares, he can sell it back to me. This 1 lakh shares, he can sell it back to me. Okay, within a certain time frame. The time frame contract would tell 1 year, 2 years, 3 years. Okay, will he sell the shares back to me at free of cost or at a specific price? Specific price. And that means if he sells the shares back to me, let's say at 50 rupees, that means how much money I have to pay to Yagnesh? 1 lakh is the shares. On each share, what is the selling price? I assume 50. That means as a company, I'll have an obligation to pay 50 lakh. This is a put option. Understood, our people? So if any instrument, once again, if a company has issued any instrument with put option, means who will have a right? Company or investor? Investor or the holder will have a right. What right? To sell the same shares back to sell the same instrument back to the company within a specific period, but at a specific price. What is the period? What is the price will be mentioned in the contract. This 50 rupees, 1 year, 2 years, all this will be mentioned in the contract. Done, sir? That's what I've written over here. So if putable instrument means the holder will have a right to what? To sell the instrument back to the company. Will the holder sell the instrument at free of cost or at a certain value? At a certain value. That means company will have an obligation to pay that amount. That's the next point I've written. If holder has a right to sell the shares, means the company will have an obligation to pay cash. Company will have an obligation to pay cash. Sir, if you have an obligation to pay cash, it is equity or financial liability? The moment obligation to pay cash comes, it is a financial liability. Understood? Therefore, the default category of putable instrument is what? Default category of putable instrument is what? Equity na financial liability. The default category of putable instrument is financial liability because putable instruments always come with an obligation. Yes, don't write. Hang on. Putable instrument always come with a obligation, right? Since there is an obligation, the default category should be financial liability. So far, everybody good? Yes, so far. That's what I've written over here. That's the reason we say equity shares are putable or non-putable. Because if you want to classify something as equity means you should have obligation or no obligation. No obligation. That's the reason we say if you want to classify an instrument as equity, generally it should be putable or non-putable. Non-putable. Because if it is putable, company will have an obligation. If you have an obligation means it is not equity, it becomes FL. Correct? That's the reason equity shares ka one of the features is it is non-putable. One is that. Now people, they have given an exception to this rule. What is that? Generally, again, once again I'm saying, generally putable instruments are what? Financial liability because company will have an obligation to pay cash. However, if putable instruments have certain features, if putable instruments have all these conditions, features are a condition. If all these below conditions are satisfied, then instead of classifying putable instrument as FL, we will classify them as what? Equity. You will classify putable instrument as equity only if these conditions are satisfied. Otherwise, default category for putable instrument is what? FL. Only if these conditions are satisfied, then only you will classify it as equity. What is that? One by one. You don't have to mug this literally because again they'll give you case study. Okay, you need to check whether this condition is satisfied or not satisfied based on the case study. So as long as you are able to decode that, it should be enough. If you remember also, great. It's pretty easy only. First, sir, use your common sense. Now, putable instrument we are classifying as what? Equity. Equity shareholders will get a right in the assets or net assets. Net assets. Now, if a company has issued putable instrument, putable instrument, and in that putable instrument they say the putable instrument holders have a pro rata share in net assets of the company on liquidation. Company has issued putable instrument now, and contract says what? These holders or these investors, they don't have right over assets, they have right over net assets in case company shuts down. Right over net asset is what? FL wala feature or equity feature? Having a right over net assets is financial liability feature or equity feature? equity feature. That's the first condition of putable instrument. That putable instrument should have a right over net assets of the company on liquidation. Done. Second one, again, common sense. Equity shareholders will get the payment. If a company shuts down, equity shareholders will get the payment first or last? Last. So that's the second feature. If this putable instrument, if it is subordinate to all instrument, this putable instrument should be subordinate to all instrument. Subordinate to all instrument means it should rank last in payment. The payment for these putable instrument holders, company will pay first or last? Last. If the payment to these putable instrument holders, if they are made in last, means again it is an equity feature. Clear, sir? A third one. Sir, you tell me, if you have equity shares, in equity shares, is there any partiality? One equity shareholder will get 1 vote, another equity shareholder will get 10 votes. Like that, there will be partiality. No, one equity shares will entitle to 1 vote. Equity shares will have different features or same features? Same features, yes or no? Meaning any partiality is done or no partiality? That is what is the next point. If you have multiple types of putable instrument, if you have multiple varieties of putable instruments, all this should have different features or identical features? Identical features. If you have multiple category of putable instruments, which we'll see in the question, right? Then all of them should have different features or same features? Same features for it to be classified as equity. If they have different features meaning one will get dividend, one will not get dividend. Like this, if they have multiple features or different features you cannot classify it as equity. It will get classified as financial liability. Like that. Okay, sir. Now, if it's a putable instrument means one obligation company will always have. What is that? If it is putable instrument means by default, the holder has a right to sell the shares back to the company and company will have an obligation to pay cash. This obligation compulsorily will come. Other than this obligation, no extra obligation should come on the company's hands. If it is putable instrument, holder has a right to sell the instrument back to the company. So company has an obligation to pay cash. This is there. Other than this obligation, no extra obligation should come on company's hand. Meaning company should not say, I will convert your putable instrument into preference shares or I will give you some extra fittings. So that like that extra biscuit or extra obligation should not be there. That's second condition. The fourth condition. Fifth one. Sir, equity shareholders will get equity dividend. Yes. Equity shareholders will get equity dividend based on what? Profits. If company earns good profit, equity shareholders may get a higher dividend. If company does not earn profit means equity shareholders will get dividend or no dividend. Means the return for equity shareholders is influenced by what? Profits. And if a company shuts down, return is influenced by net assets. If company has more net assets, equity shareholders will get more money. If company has less net assets, equity shareholders will get less money. Less money, correct? No? So that means the return for equity shareholders is influenced by net profit and net asset. If putable instrument ka return also, if it is based on net profit and change in net assets, then it is what feature? Equity wala features. If these conditions are there, then only you will classify putable instrument as equity. If it is not there means, if any of these condition fails means, default classification of putable instrument will become financial liability. Next 3-4 questions are this. Whether you will classify putable instrument as equity or whether you will classify it as financial liability. Now once can we quickly recap before we go to the question? What are we studying here, people? Putable instrument. If company is issued any instrument with put option, who will have the right? Company or the investor? Investor or holder will have a right. What right the investor will have? To sell that instrument back to the company within a particular period, 1 year, 2 years, 6 months, whatever, at a specific price. What period, what price, contract will mention. Correct? Now, if the investor is selling the shares or instrument back to the company, then company will have an obligation to purchase it by paying some money. So putable instrument always comes with an obligation. Okay, since there is obligation, the default category should be financial liability. By default, putable instrument should be classified as financial liability. However, if few conditions are satisfied, all the below conditions, if it is satisfied, instead of classifying putable instrument as financial liability, you will classify it as equity. What is that? First, putable instrument holders, okay, they should get the share in assets of the company or net assets of the company. They should get the share, pro rata share, proportionate share. They should get in the net assets of the company. They should get their payment first or last? Last. That is one. If you have multiple categories of putable instrument, means all of them should have different features or identical features. Identical features, because no partiality is allowed among them. Now, putable instrument means one obligation is already there. Other than that one obligation, no extra obligation should come on company's head. That is one. Fifth one, the return for the putable instrument holder should be either based on net profit or changes in net assets. So if this is the case, means then you will classify putable instrument as equity, otherwise no. Yes, sir, Sarji. Now can we go through like few case studies to understand this better? Okay. Alright, come to question number 8. ABC has two class of putable shares, class A and class B. So they have two class. Now which condition, you tell me? If they have two class, means partiality allowed or no partiality? Both of them should have identical features, correct? Now read this line. Two class of putable instrument is there, A and B. On liquidation, class B shareholders are entitled to pro rata share in entities' residual assets, but up to a maximum of 10 lakh. B category people, no, they will get a share in net assets, but full amount, or there is a ceiling limit? There is an upper limit. What is that upper limit? Maximum of 1 crore. I think 1 crore this is. Yes, correct. There is no limit for A shareholders. A will get unlimited amount ante. B limited will only get up to 10 lakh ante. That means you are doing partiality. Identical features or non-identical? Identical features is not there. So identical feature, for you to classify putable instrument as equity, multiple categories of putable instrument if you have, means they should have identical features. That condition satisfied or failed here? Failed. So what category? Equity or financial liability? Therefore, it is not equity. That's all. Clear, Asaru? Okay. Now 9th and 10th you do it as homework. Simple one. 11th one. S Limited issued class of putable instrument to T besides put option. So that means we have issued putable ordinary shares. Fine. Meaning put option is there. Besides put option, which is consistent with other class of ordinary shares, T Limited is also entitled to convert the class of ordinary shares held by it into equity instruments of S, whose number will vary as per the market value. Putable instrument means one obligation already there to pay cash. Other than that, we are also giving some extra features over here that we will convert your shares into actual equity shares, that too based on the market value. Correct? That means the company is taking extra obligation other than the normal one. And moreover, this is fixed number of equity shares or variable also. Number is fixed or variable. So that means what, equity or not equity? It is not equity. Okay. Now look at the 12th question. Okay, no, one liner. Comfortable, I believe, right? P Limited has issued putable ordinary shares to Q. Q has also entered into an asset management contract with P. P has issued some instrument with put option to Q. Q is also giving some asset management service to P. Q is entitled to 50% profits of P. Whatever profits P earns, Q will get how much? 50%, because Q is giving some service, no? So they are telling P, give me 50% of your profit for as a service consideration. Okay, now check. The normal commercial terms for a similar asset management service is how much? 4 to 6%. So now Q is giving asset management service to P, no? Instead of taking this asset management service from Q, if you had taken it from a third party vendor, how much commission we would have given? Only 4 to 6% of net profit. But here we are giving 4 to 6 or 50%. 50%. Now you need to tell me, sir, one of the features of putable instrument to be classified as equity is the return should be based on net profit and changes in net assets. Correct? Normal vendors are getting how much? Only 4 to 6. Here we are getting 4 to 6 or 50%. 50%. That means, do you think this is as per the normal terms? No, it's not as per the normal commercial terms. So return is not based on net profit or changes in net assets over here. So hence it is equity or not equity. Not equity. However, instead of 50%, if it was 4 to 6% means, instead of 50%, if it was under normal commercial terms means, then you could say, yeah, return is based on profits or little extra is also okay. But 4 to 6 and 50% same or completely different. Completely different. So this is not an equity. Because owners, you think, sir, will owners grab the money? Will he, see, equity shareholders are owners. Whatever profits we get, will the owner tell, hey, give everything to me? No, owner will never tell. Owner will first settle the others. First settle the others. After settling others, whatever remains, give it to me. But here he is saying, Q is saying 50% only, you give it to me. But normal commercial terms, ka commission is only 4 to 6%. This is not owner ka right. So hence, on that ground also, if you use your common sense, it is not equity. Done. So far, everybody okay? Is it fine that I continue a little longer? Half an hour more? Are you there on the same page? Possible? We have 2 numerical questions. If you are okay, I can do with that. And also maybe 2-3 small. Half an hour maybe we can cover a few questions. What do you think? Is it okay or you need a break now itself? Your call. What much? I forgot your name now. What is that again? Advait. Advait is saying, G is doing it. You want break, Advait? He's like, whatever you want to do, sir. Mentally, I've already taken my break. Okay, fine. Okay, online is saying continue, so maybe I'll go with online here. People, Ind AS ka balance sheet, right? I just showed you. As per our accounting standard, first we used to show equity liability and then assets. As per AS. In Ind AS, the category is ulta. First we will show assets, then we will show equity liabilities. I've just bought the format for your reference over here. Equity liability ka format. It will be helpful for a couple of questions. So I'm just quickly we will run through. Only the first part is different. Rest everything is pretty much same. So heading is, here is equity. After assets, first you will show assets. After total assets, you will have equity and liability. Under equity and liability, you will show equity. Okay, right? Under that, you will show equity, share capital and other equity. There we had shareholders funds, right? Under shareholders funds, we used to show share capital and reserves and surplus. Here we'll show equity, share capital and other equity. Other equity is nothing but your reserves and surplus. None, people? Okay so far? And now, what was financial statement as per AS you have learned? What are the breakup? What are the components of financial statement we have learned till now in accounting standards? Balance sheet, P&L, cash flow statement, notes to accounts. In Ind AS also same, balance sheet, P&L, cash flow statement, notes to accounts, one more called SOCI. One more called SOCI. SOCI andre? Statement of changes in equity. Statement of changes in equity. Basically, in your CA intermediate days, for share capital, we used to prepare note number 1. Reserves and surplus, we used to prepare note number 2. Here both will be combined. If you combine this and prepare one statement, that only we call it as what? SOCI. Statement of changes in equity. That means SOCI, what do you think will capture? Equity and other equity ka changes. That's all. Equity and other equity ka changes. Meaning from opening balance, how we arrived at closing balance. That change is only captured in one statement called SOCI, statement of changes in equity. It will come when it comes. I will tell you in there. Since we are discussing the format, I thought I'll bring this also to you. Everybody okay now? So we don't have reserves and surplus here. We have nothing but other equity. Yes, people. So going forward, I will say some components will go to equity, some will go to other equity. Equity here refers to equity, share, capital. Other equity means basically reserves and surplus. Done, sir? Under other equity, we could have various reserves. Right? That is fine. As and when we cover the topic, we'll do. Then you will show your liabilities. Under liabilities, you will show non-current liabilities and then your current liabilities. That is fine. Breakup, you don't worry about this. They would have given a lot of all that. No need to break your head about that. But are you comfortable with these two? This will come in your questions. I want you to be comfortable with that. Yes, sir. All this, each and individual standard, when we go on covering, it will keep coming in. So this we don't have to study now. It will automatically covered when we cover the respective Ind AS. Okay, now listen to this. If you're comfortable with that. Now there's a small concept called reclassification. There is a small concept called reclassification. Reclassification between FL and equity. Between FL and equity. Meaning, let's say initially the classification was financial liability. Then the classification changed to what? Equity. Possible, right? Earlier, variable number of equity shares was issued. Earlier, we had a contract where through which we had to issue how many? Company had to issue their own company ka equity shares. Fixed number or variable? Variable number. For you to classify it as equity, fixed to fixed test should be passed. Consideration received as well as number of shares issued, both should be fixed. Here, number of shares was fixed or variable? Variable. So we classified as what? Financial liability. Later, contract terms were modified. And we said we will issue fixed number of equity shares. Contract terms got modified and fixed number of equity shares are issued now. That means now you tell classification is FL only or equity now. From FL now it will become equity. Possible? Okay. Now that's only we calling it as reclassification. Reclassification means from FL it is becoming equity or from equity it is becoming FL. That was a scenario. So from FL financial liability, if it becomes equity, what to do? Simple people. Equity mein we have obligation to pay cash or no obligation? No obligation, because all these are permanent numbers, right? Hence what the standard says is no need to find fair value. You already have financial liability ka carrying amount, because still now you are showing that component as what? Financial liability in your books. So it will have a carrying amount. Whatever is the carrying amount of financial liability, same thing you make it now as carrying amount of equity. So what is the reclassification measurement basis? Fair value or carrying amount? Common sense, because even if you use fair value, pointless. Why? Because will we settle equity or no settlement? For equity, there is no obligation to settle. Hence, company is saying don't waste your time finding fair value. Whatever is the carrying amount of financial liability, same thing you make it as carrying amount of equity also. So reclassification measurement basis is fair value or carrying amount? Carrying amount. Which day ka carrying amount? First day ka na? No. On the day this reclassification happened, that day ka carrying amount you find. And from FL you make it to equity. So whatever is the carrying, if carrying amount of financial liability on the date of reclassification was 1 lakh, means same 1 lakh will become carrying amount of equity. That means is there any gain loss or no gain loss? No gain loss. Yes, no. Because same value. FL ka same value is becoming equity ka value. So no gain loss. Done, Sirji. Correct, Sirji. Any doubt, Sirji? Advait.
We can't bifurcate the number of shares. The denomination.
I didn't understand your question. Huh?
1 to 3 is the carrying.
Huh?
1 to 3 is the carrying.
Okay. No, we don't have to find out the number of shares over here. Just saying, if initially, see what happens is sometimes when you enter into a contract and all, right, you can enter into a variable sort of a contracts also, no? Like convertible preference shares. Convertible preference shares. In convertible preference shares, we have to convert into equity shares. The contract said we will convert it based on the market price. Number of equity shares we will issue fixed or based on market price. On the conversion date, we will check market price. Based on that, we will issue equity shares. Now you tell me, number of equity shares is fixed or variable? Number of equity shares is fixed or variable? Variable, because it is based on market price. I mean, this preference shares you will classify it as financial liability. Okay. Let's say the term of this preference shares is 10 years. After 5 years, company said we will issue 1 lakh equity shares for conversion. Based on market price or now became fixed? Fixed. Now you tell me, is this really a financial liability or equity? Is this really a financial liability or equity now? The reason for you to classify financial liability was we were using market value. Number of equity shares was fixed or variable? Variable. Now after a few years we modified the contract. Now is the number of equity shares variable or fixed? Fixed. That means now we will have to change the classification from FL to equity. Right? So this preference shares will have a carrying amount in your books, no? Right? The same carrying amount you make it as equity. Okay. How to do the accounting? What it is, I'll tell you. Maybe you're worried about the accounting. It will come. Today's If time permits, today only I will show you that convertible preference accounting problem only is there. No need to worry about that. Fine, people. But basically, we have to use fair value or carrying amount. Carrying amount. If carrying amount of financial liability is 10 lakh means the same 10 lakh will become equity ka carrying amount. Done, sir. If you want the entry also, what entry you will pass here? Tell me. Financial liability you need to cancel. Financial liability has what balance? Credit balance. How do you cancel it? Debit. So the journal entry will be financial liability account debit to equity. If financial liability ka value is 10 lakh means equity ka value also will be 10 lakh. Now tell me, any gain or loss is coming now? That's what we said over here. No gain or loss will arise because you are using carrying amount. Padani, okay? We said once more. Comfortable now? Mohan Amacha? Done. Okay. Now ulta case. What is the ulta case? Equity to financial liability. Earlier, same case. Earlier number of shares was fixed. Now contract was modified. Now it is fixed or variable? Variable. If number of equity shares becomes variable means is it an equity or financial liability? So far we used to show it as equity. Going forward we have to show it as FL. Correct? Now 1 minute, hang on. Previous case when you did classification, we used fair value or carrying amount? Carrying amount. Why did we use carrying amount? Because for equity there is no obligation to pay cash. On equity there is no obligation to pay cash. Whether you show equity at 10 lakh or whether you show it at 10 crore, till the company shuts down. We will never repay this amount. So there is no obligation. Since there was no obligation, we used what amount? What basis? Carrying amount. But on financial liability, there is no obligation to pay cash, or there is? There is. So we will use carrying amount or fair value here. Fair. Because we do have obligation to settle, no? So hence, here we will not use carrying amount. Carrying amount of equity will not become carrying amount of financial liability. First, find out the fair value. They will give you all this data. So fair value on the date of reclassification will be used. Okay, just to give an example, let's say equity ka carrying amount is 10 lakh. Equity ka carrying amount is 10 lakh. Let's say fair value is 12 lakh. Fair value is 12 lakh. Pass the journal entry for me. Let's see. From equity, you are reclassifying it to financial liability. Equity also has credit balance. Is it equity now or cancelling? Cancelling. So what is the journal entry you will pass for this? Equity account debit. How much is this, people? 10 lakh. To financial liability, how much? 12 lakh. Journal entry matching or balancing figure? Balancing figure 2 lakh is there? No. That will go off to other equity. That will go off to other equity. Calculated or balancing figure? Balancing. Done, sir ji. Sir, you can write SPL, no, sir? 1 second. There is one small funda over here. Sir, anything related to equity. Listen to the sentence carefully. Anything related to equity, right, will never go to SPL. If anything is related to equity or equity shareholders, it will never go up to SPL. It will be directly booked where? In SOCI under other equity, or balance sheet only directly you will show it under other equity. So you will not write under SPL. Because dividend and all, now dividend is paid to equity shareholders, right? Equity dividend you will show under SPL. Equity dividend you will show it under SPL, or directly you will reduce it from reserves and surplus. We used to reduce dividend from reserves and surplus in balance sheet in CA intermediate, correct? So same funda here also. That's what I've written over here. Any equity related gain or loss. If an instrument is classified as equity, equity related gain or loss will always be booked in other equity, not in SPL. Directly other equity. So that means in my example, you will not use SPL, directly other equity. That's it. Okay, Zaru. Can I move on to the next couple of questions? Both are similar.
We issued preferences.
Mm-hmm.
So initially we classified it as financial liability. So after the term, we issued the equity share. So that is also
Correct. That is true there, but maybe I agree with your question. Let's do a thing. I think the same thing will come as a question. Can we do that question with journal entry? I think you may get a better clarity, right? So yeah, I got it, but I think we have a numbers. Instead of probably waiting now, it'll maybe 9:30ish it may come. Let's see. Today you told you're ready to stretch and no, like He's saying a break. We told we will give, we want more breaks, sir. We didn't tell we want more class, sir. Okay, no issues. Fine, we'll see. No worry. Maybe question number 13, I'll do it in a bit. First, maybe I think we'll do let's do question number 14. I think it has a little better context. It has a little better data to do it. Okay. After doing 14th, I'll come back to 13th. Let's do this first. Parent company P, they hold 75% controlling interest in subsidiary. Fair enough. It's with more than 50%, automatically you get control. So P is parent, S is subsidiary. The remaining 30% shares of subsidiary is held by entity Z. Okay, so S has two shareholders. P to the extent of 70%, Z to the extent of 30%. That's a shareholding pattern. On 1st January 20x1, P writes an option to Z. So that means there's a transaction happening. Is S involved here? No. P has and Z have made some contract. Check. On 1st January 20x1, P writes an option to Z which grants Z the right to sell the shares to P. The right to sell the shares means put option. Putting back means purchasing or selling. Put option is always associated with sale. Call option is always associated with buy. Call back means buying back. Put back means selling. Okay. So P writes an option to Z. Okay. Through this option, who has the right? P or Z? Z has an option. Z has a right. What right? To sell. Z is holding how much shares in S? 30%. That 30% share, Z, if they want, they can sell the shares. They have a right to sell the shares to P. On 31st December 20x2. So they made the contract on 1st January. This contract will expire on what day? 31st December. I mean, this put option, 1st January 20x1. But if Z wants, they have to exercise this option within 31st December 20x2. So the period is how many years? From 1st Jan 20x1 to 31st December 20x2 is 2 years. Okay. For how much value? 1000. As I told you, the period and the value will be determined. So Z will sell the shares, 30% shares to P at what price? At 1000. Within how many years? 2 years. Correct, sir? And this is not an obligation. This is a right. If Z wants, they can utilize this right and sell. Or if Z wants, he can say, I don't want to sell the shares. Absolutely their choice. I know people, it's option. Option means not compulsory. Option means option. Yeah. All right. Parent P receives a payment of 100 for the option. Now P took an obligation on their head, no? Right? So for that, we say all these are option premium, we say. So P collected how much money from Z for giving this option to Z? Now P is giving one right to Z, no? Because Z has one extra right now, P is telling Z, give me 100 rupees for this. Because I'm giving you some extra benefits. Now, to get the extra benefits, you need to pay me. This we call it as options premium. How much P collected from Z though? 100 rupees. The applicable discount rate is for put liability is determined to be 12%. Okay, I'll talk about this in a bit. State how this should be recognized. How you should do the accounting. Right now, we'll quickly go over through the accounting of this. This is one off question, so I'll finish off accounting for this. Now, people, we have to do the accounting from P's books, okay, that they have forgotten to tell. We are doing the accounting from P Limited ka books. Maybe if you want, you can write there in P Limited books. One by one. First, people, observe. P has given a right to whom? Z. Now, who has the right? Z. Z has a right to do what? Z has a right to sell the shares to P for how much value? 1000 after 2 years. Agreed? Sir, if Z says I want to sell, Z decides that they want to sell, can P back out? Can P say no? P has to pay, make that payment. P will have an obligation to pay how much? 1000 rupees to Z. Agreed? Sir, if P has an obligation to pay means we have to create equity or financial liability. Financial liability. Agreed? That means in P's books, because P has an obligation now, because Z has a right to sell, P has an obligation to purchase by paying money. So since P has an obligation to pay money, they have to recognize what in their books? Financial liability. Agreed. Now P will have to buy it at what price? 1000. That means can P show 1000 rupees financial liability today only? Today means 1st January 20x1. Would that be appropriate? Will P Limited pay this 1000 rupees now or after 2 years? After 2 years. I mean, this 1000 rupees is not today's value. It is a value after 2 years. But we are doing the accounting now. Correct? No. That means we will recognize it at future value or present value? Present value. To calculate present value, we need discount factor. Is it given? At 12%. So calculate that for me. P will pay this 1000 rupees every year or once? Once. That to now or after 2 years? After 2 years. So second year ka discount factor at 12% you need to find. 1 divided by 1.12 press equals to button 2 times. How much is that? How much? 0.797. Huh? So 1000 is the future value. PVIF, present value interest factor is 0.797. So that means present value is how much? 797 rupees. This is working note number 1. Any drama or got it? Got it? Okay. Now P, did they receive any money to give this option to Z? Did P collect any money? Yeah. P collected some money today only. How much is that? Option premium of 100 rupees. So that means from P perspective, money is going out or money is coming in? Coming in. So first journal entry, it's an easy thing. Check the journal entry. I pass the journal entry in columnar format. First journal entry P will passes. Bank account debit 100. This is related to equity shares. No, equity shares only we are buying. Right? So bank account debit to equity directly 100 rupees. Bank account debit to equity 100 rupees. Equity here refers to other equity. If you want, you can write bank account debit to directly other equity. Clear, sir? First journal entry. Okay. Fine. But the moment P enters into a contract, P will get an obligation. The moment this put option contract is entered, Z will have a right to sell the shares to P. And P will have an obligation to purchase it by paying cash. So P should recognize what in their books also? A financial liability. P will purchase it at what price? 1000. But they will purchase of 1000 happen now or after 2 years? After 2 years. That means we are doing the accounting now. So should we recognize it at 1000 which is at future value or present value? What is the present value we found? We multiplied discount factor and found the present value to be 797. So P has to create a financial liability to the extent of how much now? 797. Agreed. Agreed. Financial liability. All liabilities will have debit balance or credit balance. Liabilities will have debit balance or credit balance. Credit balance. Now we have to create this liability. So we will write to financial liability 797. Agreed. You will debit bank. You will debit bank. No. Did we receive this money? No. In fact, we have to pay this money. So that means you will use your other equity. So journal entry again you will pass this other equity account debit to financial liability. This is the second entry to create. Instead of equity, you can write other equity people. Absolutely no issues. Okay. Yes. Second part of the accounting you already know. How much P has to actually pay? 1000. But how much have you recognized now? 797. 797 is a present value. 1000 rupees is a future value. We already know. Difference between future value and present value is time value of money ka interest charges, which goes off to SPA. But interest charges, you'll have to book it for 1 year or 2 years. 2 years means normal or one table. What is a table? Unwinding of interest table. Is that new thing to us or done? We know. Tell me the format. Let's see how much we remember. Year, opening balance, finance charges at discount rate, 12%. Payment, closing balance. Correct? So how much is financial liability ka present value so far? How much have you accounted initially? 797. So opening balance is 797. You will book the finance charges at 12%. So calculate 797 ka 12%. 96. Okay, ji. I'll round off maybe. Yeah. Payment. First year will P make any payment or second year? Second year. So first year it is payment is 0. So how do you get closing balance? These two ka addition minus payment. Correct? No. So how much is this? These two ka addition minus this will give you 893. First year ka closing CB is OB is opening balance, CB is closing balance. First year ka closing balance will become second year ka opening balance. Now second year we know that the value of financial liability should become 1000. So don't calculate second year ka interest. There will be round off. Calculate directly. How? If you want, you can write payment column में 1000, or if you want, you can write closing balance 1000. Why? Why payment column I am not writing is P has this right or other party. Z has this right. After 2 years, Z may say, I don't want to sell the share. If Z says, I don't want to sell the shares, will P Limited pay 1000 rupees or they don't have to pay? They don't have to pay. So that means Pakka P Limited will have to pay or not, or it depends on Z. It depends on Z. Hence, I have not written payment column. Payment column I have written 0 because it depends on the other party ka action, whether they want to utilize that right or allow that right to lapse. Hence, payment column I have written 0. Closing balance we'll have to make it as what? 1000. So 1000 minus 893, you do. What are you getting? 1000 minus 893, how much? 107. That is your second year ka finance charges. Clear, sir? And tell me the journal entry for finance charges. This also we have done. Finance charges is an expense. Expense to be debited. So the entry is finance charges account debit to financial liability. That's your second journal entry. First year ka finance charges 96. Second year ka 107. All this we have done already. Correct? No? Remember, no, everybody? So finance charges to financial liability for 2 years we have done the entry. Clear? Now when you come to end of second year, now there could be two things. What can happen? One of the two things can happen. What are those? Either Z can tell, I will sell the shares. If Z says, I want to sell the shares, P has to pay 1000 rupees. Correct? Or Z may say, I don't want to sell. Meaning Z can exercise the option and Z can make the option to get lapsed. If option gets exercised, meaning if Z says, I want to sell the shares, then P has to pay the money. So that means the liability. P has already created a liability. What is liability ka balance in P Limited ka books? Check if you want. Obviously it is 1000 because your unwinding of interest table is saying financial liability ka closing balance is 1000. If you want, you can reconfirm also. Liability, no, where and all you have credited, you add. Where and all you have debited, you minus. Financial liability. Here credit, here credit, here credit. If you add, obviously you will get 1000. Okay. Now P has to pay how much liability P has to settle if Z exercises his option? 1000. What's the journal entry for liability settled? Journal entry for liability settled. Creditors paid. What is the journal entry? Creditors to bank. Similarly, any other liability if it is settled means liability to bank. What is the name of the liability we calling? Financial liability. So what is the entry for settlement? Financial liability to bank. Which year? Second year. How much amount? 1000. That way drama is done. Clear? Okay, sir. Once more, sir. Got it, sir.
Sir, sales.
Ah.
If Digit sales,
Hmm.
then we got the shares.
Hmm.
So that means equity.
No, it is not our share. Subsidiary ka shares we have got. Z will give what? Subsidiary company ka shares to us. Okay, that is in consolidated financial statement, mein subsidiary ka shares will not show. Instead of goodwill or bargain purchase, gain will come. That accounting will do it in consolidation. No need to worry about that. I know. All right. Next. Everybody okay? What if Z decides to let the option get lapsed? Z is saying, I don't want to sell the shares. That means option will get exercised or lapsed. Lapsed. Sir, if the option lapsed means P Limited has obligation on their head or no more obligation? Is this liability required for, is this P required to pay 1000 rupees or option has got lapsed? Lapsed means should we show this liability or cancel it? Cancel it. How do you cancel a liability which has credit balance? Debited, right? Are we settling it or cancelling it? Cancelling it. So what is the entry you? For creating liability, what entry you passed initially? To create 797, what entry you passed? Other equity account debit to financial liability. For cancellation, financial liability to other equity. 1000 rupees. That's all it is. Okay, na sir? Everybody good? Yes? Now, in fact, if you want, we can take Agnesh ka question also. If the option gets exercised, we will receive subsidiary ka shares. No? In consolidated financial statement, mein subsidiary ka investment we will not show. Instead of that, goodwill will come. If you remember, AS 21. But if you're doing SFS means what? Separate or standalone financial statement. If you are preparing only P Limited ka financial statement, P Limited received S Limited ka shares. No, how much shares? 30%. That is an investment. So you can pass one more journal entry, investment in subsidiary account debit to other equity. Whatever the value of the investment you have received. That data they have not given, so we have not passed the entry. That's all. Okay, now. But yes, you are right in that sense. In CFS may it will not come. SFS may investment in subsidiary will come. What value? Not given. Not our botheration for the time being. Easy, sir. Now give me a walkthrough of this entry. Let's see. What entry you pass? Give me a walkthrough. P had given us option to whom? Z. What option? Put option. Put option means P will have a right or Z will have a right. Z will have a right to sell. That means P will have an obligation to buy. Now or after 2 years? After 2 years. At what value? 1000. But obligation is there. If obligation is there, P has to recognize a liability called financial liability. Now, will you recognize financial liability at 1000? No, that is future value. Hence, first what we did. Find out the present value. So, what is the journal entry we booked initially? Other equity account debit to financial liability. To give this option to Z, did P collect any premium? Yeah, they collected 100 rupees premium. So, the entry is bank account debit to other equity. Now, this financial liability, you have shown it at present value platform. Will the settlement happen at present value or future value? Future value. For that, we need to prepare unwinding of interest cut table. How many years? 2 years. Why 2 years? Period is 2 years. So, year, opening balance, finance charges, payment and closing balance. So, I am based on this book finance charges ka entry. What is finance charges ka entry? Finance charges account debit to financial liability. Then, when it comes to the second year ending, one of the two things can happen. Options may get exercised or it may get lapsed. If option is exercised, P has to settle that financial liability by paying cash. What entry? Financial liability account debit 1000 to bank account 1000. Financial liability closed, all drama closed. If the option get lapsed, still P Limited has already created a liability in their books. Now, if option has got lapsed means, is that liability required or no more required? No more required. Cancel it. What is the cancellation entry? FL to other equity. The same thing you'll have to do it in question number 13 also. But data is not given. We have assumed the data and pass some entry. Okay, now but entry pretty much the same thing. Can we quickly review this maybe? Okay. Question number 13 now we just check. On 1st January 20x1, entity X writes put option. Writes again put option over what? 1 lakh of its own equity shares for which they receive 5 lakh rupees premium. Sir, in the previous problem, there were 3 companies, P, S, Z. P had written put option where Z had a right to sell subsidiary ka shares to P. But here three entities or only 2 entities? Entity X has written a put option of 1000 shares where it will buy back its own shares. It will buy back its own shares, not subsidiary ka shares, its own shares. Who has this option? The investor. What is the name of the investor? They have not given. It's fine. But did we collect any premium for giving this put option? Yeah, for giving this extra benefit, we collected how much premium? 5 lakh rupees. Okay. Under the terms of the option, entity X may be obliged to take 1 lakh of its own shares in 1 year's time. So settlement will happen in 1 year. At what price? What is the exercise price of that option? 2 crore 20 lakh. In the previous problem, exercise price was 1000. Here it is 2 crore 20 lakhs. Yes, Aji. Everybody good, Aji? And now, option can be only settled through physical delivery, blah, 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 blah. Accounting, they've asked. Now, people, since we have written a put option, entity X has written a put option means entity X will have an obligation. For obligation, what we need to create? Financial liability. But this obligation will come now or after? Settlement of this obligation is now or after 1 year? So this 2 crore 20 lakh, I think I've taken it as lakhs, people. Okay, let's modify. Since I've already written the solution in lakhs, so here instead of 2 crore 22 lakhs, so make it as 22 lakhs. Better, 1 0 you cut off. I don't want to change my solution once again. Yeah, I have taken it as 22 lakhs and solved. So here also you make it as 22 lakhs because anyway concept is same, no? Yeah, 22 lakhs. So that settlement will happen at 22 lakh now or after 1 year? After 1 year. But we are doing the accounting now. So will you create financial liability at 22 lakhs or present value? Present value. But discount factor given now. So I have assumed present value as 20 lakh and did the accounting. Just to show you. Okay. Actual could be anything. Now you tell me if the present value is 20 lakh. Assumption. You tell me the breakup now. Entry you tell me now. I have given you the present value. 20 lakh. First go on telling me the entry. First, option premium collected. What journal entry? Bank account debit to other equity. How much? 5 lakh. Done. Equity, or you can write other equity, is fine. Next. We have to create financial liability. Financial liability, you will create it at 22 lakhs or present value? Present value. How much we have assumed present value to be? 20 lakh. What's the journal entry? Other equity to financial liability, 20 lakh assumed. Okay. All right. Next, we have to put unwinding of interest. Required or not required? Only 1 year. No. Only 1 year. Future value is 22 lakh. Present value is 20 lakh. So what is the difference? 2 lakh. That difference is many years ka or only 1 year ka? For 1 year ka finance charges, you need whole table. Huh? So what is the entry for finance charges? Finance charges account debit to financial liability. How? How much? 2 lakh. How 2 lakh? Future value 22 lakh. Present value assume 20 lakh. So difference 2 lakh finance charges. Now at 1 year's time, one of the two things may happen. What are those one of the two things? Option may get exercised or it may get lapsed. If it is exercised, what is the journal entry? If it is exercised, we'll have an obligation to settle financial liability. What is the entry? Financial liability to bank at what value? 22 lakhs. It's not 2 lakhs, sorry, my bad. 22 lakhs. Correct? If it is lapsed, what journal entry will pass? Financial liability to other equity. How much financial liability you have created so far? If you want, you can just check. Here you credited by 20, here you credited by 2. So financial liability balance in our books is 22 lakh credit balance, which you will cancel by debiting it. So financial liability debit 22 lakhs to other equity 22 lakhs over. Just have assumed for the sake of accounting. Okay, sir. And this is done. Now this table not required. We already know. Sir, if you want to classify it as equity, if you want to classify an instrument as equity, F to F should be passed. What is F to F? Fixed to fixed. What are the two components that should be fixed? Consideration received should be fixed. Number of shares issued also should be fixed. So actually this table is faltu. Sir, if both are fixed, then only it becomes what? Equity. Even if one of the number becomes variable, automatically financial liability. See here, this is fixed, this is variable. What is the classification? Financial liability. This is variable, this is fixed. Still FL. Both are variable also means financial liability. Table really required? No. For it to be equity, both should be fixed. If both are not fixed, automatically it becomes financial liability. So table really not required. Okay. 15th you take it as homework. Okay. I think, can we take a break and come back and do the remainings? Is it fine? Yeah, I think next only 3-4 small questions are there. I think then we can get to the next part. Okay, no issues. Let's take about, it's 8 now. Can we resume back by 8:15 people? Come back by 8:15? All right. Thank you.